Welcome, everyone. I am really glad you could join us tonight. Tonight, we're going to walk through the top strategies to help dentists and healthcare professionals make smart financial decisions and tax moves before year end. This time of year is all about fine tuning your plan, minimizing taxes, maximizing savings, and making sure your money is working as hard as you are. If you're joining live, great. Appreciate it. If you're catching the replay, welcome as well. Either way, you'll walk away with practical steps that you can put in place before December 31st. So let's get started. Here's what we'll cover. We'll start with the importance of year-end planning, then jump into what's new under the 2025 tax law, the One Big Beautiful Bill Act, which I will refer to as the OBBBA. From there, we'll break down practice level tax moves, personal and family planning strategies, retirement optimization, charitable and legacy opportunities, and finally, how to align everything with your broader life goals. We'll wrap up with an action list with some resources to help you finish the year strong. If you have any questions, please put it in the chat. I'll take time at the end to answer any questions you may have. So let's get started. So the power of proactive planning. So when it comes to taxes and financial planning, timing is everything. It's not just about how much you make, it's about how much you keep. The decisions you make before year end can have lasting impact on your savings and long-term financial health. I like this quote that says, tip your server, not the IRS. They're allowed to tip. Don't give the IRS any extra. Give them just what is needed. The most successful dentists I work with treat tax planning as an ongoing process, integrating cash flow, business structure, and personal goals so that every financial move supports their bigger picture. So this slide is very meaty, but it's very important to understand. This year's biggest update is the One Big Beautiful Bill Act. It was signed early in 2025, and it keeps many of the 2017 Tax Cuts and Jobs Act provisions alive, including lower income tax rates and 20% qualified business income deduction for pass-through entities, which we'll talk about more later. Bonus depreciation and Section 197 expenses are extended, which is great news for anyone investing in new equipment or office upgrades. The state and local tax deduction cap temporarily jumps to $40,000, giving some relief in the higher income states. The estate exemption raises to around $15 million per person. A new deduction appears like tips, overtime, and an extra $6,000 standard deduction for those over 65. Bottom line, this bill gives us clarity for planning ahead and several short-term opportunities we can act on before 2026. So what does this mean for you? For dentists and healthcare professionals, these updates matter in three big ways. First, your business structure and income flow determine how you will qualify for the deductions like qualified business income or QBI. Second, equipment and capital purchase remain effective tax shelter through bonus depreciation. So that can be a big benefit. And third, it's a prime window to make retirement contributions and charitable gifts before some of these provisions phase down or change in 2026. For practice owners, 2025 is a year to fine-tune, manage income timing, optimize expenses, take full advantage of new deductions before they get tightened in 2026. So now we're talking about practice level, right? Your largest source of income and opportunity. First, make sure you review your entity structure with your CPA and your financial advisor. S corps and partnerships can help manage self-employment tax and optimize income. If you're any of these other entity structures, there could be opportunity for you to save more in taxes. Second, evaluate equipment or technology purchases. Section 179 and 100% bonus depreciation are still in play. That's powerful for big ticket upgrades like imaging, chairs, digital systems. Also, it could be beneficial if you purchase a practice in the last 4 years and you haven't done a cost segregation study. This can optimize those tax deductions in 2025. Third, consider income expenses, timing income and expenses, deferring collections, accelerating certain payments before year end can smooth your taxable income. The goal is simple. End the year with a tax smart practice that's efficient and profitable. Next, now let's bring it home. Your personal and financial planning. This is time to review college savings through 529s. Make sure you max out your HSA contribution and even consider Roth conversions if your income is in a favorable bracket. For those who are charitably inclined, donor advised funds are still one of the most flexible ways to give. It's a fund where you get to deduct it now, so you get to donate whatever amount you want today, but then you decide later where you'll grant those donations. So it gives you a lot of flexibility and you can front load a lot of deductions right now. And don't forget insurance, life, disability, umbrella coverage, personal P&C, practice P&C. These coverages should evolve with your income and lifestyle, so you need to make sure those are up to date. If you take the time, if you'd like to discuss any of these moves, see if they make sense for your family, feel free to email me. I'll provide my email later in at the end of the presentation, but I'm happy to set up time to talk one-on-one. Feel free to also, if you feel comfortable share in the chat. We can get some, engagement going. Next is retirement planning. Retirement planning is one of the biggest year-end opportunities to reduce taxes while building long-term wealth. I usually like to say retirement planning is like putting money that's taxable, like from your left pocket, and putting it into your right pocket, which is either tax deferred or tax free. You're not losing that money, you're just putting it in a different pocket with a different result. So make sure your 401k and profit sharing plans are maxed out. Your 401k plan, you would contribute prior to 12/31. You also want to get a sense of how much your profit sharing will be for 2025, but that contribution can be made prior to filing taxes. If you're a high income earner or need to catch up on retirement, consider adding a cash balance plan. This can create 6 figures plus deductions in the year you contribute and accelerate your retirement savings. If you haven't looked at a cash balance pension plan or even profit sharing, it's definitely something to consider. If possible, defer income into next year. That can lower this year's tax bill while aligning with future goals. And under the OBBBA, the coordination between qualified plans, estate exemption, and Roth conversions give us more room to customize your long-term growth. Next, charitable giving. It continues to be a win-win-win strategy, especially before the OBBBA, the new act changes the deduction limits that hits in 2026. The reason why it's a win-win-win is you get the tax deduction, you get to give to a charity or a cause you find important, but also there's proven studies that giving back, whether it's monetarily or with your time, really improves well-being. It makes you happier, it makes you more fulfilled. So you really should consider this in whatever level you can. Again, you can front load gifts in 2025 to maximize deductions now, or use a donor advised funds to spread that giving over time. If you have appreciated investments, donating directly to avoid capital gains and this still counts as a full deduction. So it's a win. And for legacy-minded dentists, whether you're older or you really want to focus on your legacy, 2025 is a key window. With the state exemptions still high, gifting or trust funding can now secure long-term savings for you and your family. Again, if you have any questions, throw it in the chat. But now let's zoom out from the technical side for a second back into how we implement this in life. The best financial plan is one that supports your life, not the other way around. At NaviPath and myself, we call this the balanced wealth blueprint, connecting your financial goals to what really matters to you, whether it's family time, freedom, fulfillment, travel, extracurriculars. We want that all to be built into the plan. We help design a plan that balances practice success with personal peace of mind. And if something resonates tonight, maybe if you'd like to refine your plan, again, just send me a note and we'll schedule a quick call. So here's some actionable items as we get close to the end of this webinar. So these are more evergreen. These are things you can do every year. And the next slide will be stuff that might sunset in 2026. So it needs to be done in 2025. So first of all, maximize all retirement and HSA contributions. Confirm charitable gifts or donor advised funds are fully funded. And if you would need to fund more, review income and expenses with your CPA to capture every available deduction. And again, evaluate insurance and estate plans for coverage gaps. The key here is not waiting until tax season. Making these moves now means you'll be in control of your 2025 outcome, not reacting to it next spring. So now here's the top 7 year-end tax tips under the new act. First, front load charitable giving before 2026 to avoid the new adjusted gross income deduction limits. This could be relevant, but a lot of my dentist clients don't have these unless their spouse is involved. But exercise employee stock options, right? ISOs early if applicable, because next year's alternative minimum tax rules will be less friendly for those stock options. Take advantage of 529 expansion if you have 529 balances. Now up to $20,000 for K through 12 or credential related expenses, even reimbursing earlier 2025 costs. So you can really take advantage of that now. Also coordinate Roth conversions carefully. New deductions phase out between 2025 and 2028. Given the low tax environment now, if you have a lot of tax deferred investments, you could really lock in that tax-free income or tax-free investments now at a reasonable tax rate. Mind your QBI thresholds, qualified business income. Most of my clients are just not fully aware of the benefit of this. The 20% deduction for dentists and other healthcare professionals starts phasing out around $383,900 for joint and $191,950 for single. It fully phases out around $430,000 and $230,000. So you go from getting a 20% deduction to 0 after that full threshold. So if you can do retirement contributions, profit sharing, cash balance, charitable deductions, and you're in that kind of threshold range, it could really benefit your overall tax deduction because you can push yourself down for your adjusted gross income and maximize that 20% deduction. Could be relevant, but you could complete an energy efficient home improvements because you can still claim up to 3,200 in credits through the end of the year, not after. Meet with your CPA before December 31st. Align income, deductions, and contributions to lock in those benefits before 2026 changes take effect. So these are the things you need to do this year if they're relevant. I'm going to take a look at the chat, see if there's any questions. Not at the moment. We got one. So we have with charitable giving, I assume that should and can come out of the business account. For those deductions, whether you pay it out of your business account or personal, you get the same deduction. It's technically a personal deduction, but whether you do it out of your business or your personal, that flows down to your personal and then you deduct it there. But using a donor advised fund, you can front load those and get that benefit today. Other questions I have, I get a lot around clients is, when is the right time to consider profit sharing or even a cash balance pension plan? It depends. The ideal structure is if you have an older owner and younger staff, then the calculations benefit the owner usually more. But that's not always the case. So if you have high income, so income over what you're spending, so if you have a lot of excess income and you don't want to get hit with a big tax bill, it's worth getting an illustration to see if a cash balance or profit sharing plan will work for you. That's one of the questions I get a lot. I also get the question on estate planning. You should update your estate plan every few years. Make sure your beneficiaries are updated and match what you want to happen in your estate plan. And again, some of these things need to happen before year, and some you need to consider at year end, but can be implemented after the fact. So as we close, thank you so much for joining tonight. Again, if any of these strategies at home, whether it's optimizing your practice taxes, exploring retirement options, or planning for 2026, send me an email and we can set up time to connect. You can reach me directly at brian@navipathfinancial.com or text at 704-248-6090. Don't forget to check out my podcast, or Wealth, Prosperity, and Practice. It's on YouTube or wherever you listen to podcasts. We break down these same concepts in an easy to understand way for dental professionals. Again, thanks again for making it tonight. And here's to making the rest of 2025 your most tax efficient and financially fulfilling year. So thank you again, and I look forward to hearing from you.